Hello, welcome to the Butchers Think Tank. We're going to get started on a quick video here. This is going to be a really short one, basically, with regards to the reverse repurchase program and the reverse repo agreement. Again, hello, my name is Marcel, Kalinovic, the Butcher of Wall Street. This video is the next in a series on the macro and geopolitical implications of over-leveraged banks, hedge funds, and Federal Reserve and their effects on the stock market, equities markets, bond markets, real estate, and so on. That being said, I hope everyone's having a great day. Today we had nearly another all-time high today at $2,156,000,000,000, $13 million in overnight repo operations and reverse repo operations, which is the purchase of securities in exchange for cash. 105 counterparties participated today alone.
The Fed coming off a big test in its efforts to...
This was for September 30th, 2019, just about a week and a half after the Federal Reserve had to take over the reverse repo due to the fact that it was completely crashing as lenders kept raising rates higher and higher as the risk just increased.
To calm the short-term funding market, Dom Chu joins us now with the latest on the Fed's repo operations. Hi, Dom.
All right, so Courtney, the biggest banks in America tapped the New York Federal Reserve for $63.5 billion worth of overnight cash borrowing via the repurchase or repo market. That was earlier this morning. The Fed would have allowed up to $100 billion of those loans, so the offering was securing overnight cash, and it was undersubscribed. Now, one of the more positive interpretations of this is that there isn't as much of a pressing need to access Fed cash as there has been in recent weeks, meaning ultra short-term interest rates have now stabilized. Now, it was a closely watched money market operation this morning.
Now, everybody, this was September 30th, 2019. The reverse repo was at a whopping $63.5 billion. People were freaking out. Today, it was at $2,156,000,000,000, $13 million at an offering rate of 2.30%. That is an overnight bailout for the world's largest banks and participating counterparties.
Given that surge, as you can see there, in overnight borrowing rates that occurred earlier in the month, some had said that the surge in rates could signal the early stages of a possible credit event that could lead to a broader market downturn. The Federal Reserve itself then stepped in.
That downturn would have been what was organically going to happen if it wasn't for the fact that the federal government and the CDC implemented a plan to use COVID, whether it is real or not real or manufactured in Wuhan by CIA-sponsored entities or not, is not the point. The fact is that COVID was the scapegoat for the Federal Reserve and the central banks to print infinite amounts of money.
And to supply cash to the system through overnight and 2-week term repurchase agreements or repo agreements to make sure that the financial system was adequately supplied with cash. The bottom line here, folks, is that it worked. There is a consensus, though, building up that one of the reasons for the spike in those rates had to do with the unintended consequences of the Fed's efforts to boost cash in the system in the wake of the financial crisis a decade ago. You mix that with new bank regulatory requirements on capital. You mix that with seasonal demands for cash by big bank clients, and you get what we saw. The bank-to-bank lending market plays a mission-critical role in the way our financial markets operate, but up until now, it's only really been talked about by those in the cash and collateral trading businesses and money market circles. It is now fair to say that much of Wall Street is now paying a lot of attention to those money markets as a possible indicator for any kind of potential systemic stress in the future. So, Carl, those rates, very key for right now. They are stable. We'll send things back over to you.
Hey, Dom, given that today is the last day of the quarter, I mean, is there a sense out there that, this has been...
Granted, that was the last day of the quarter, last day of the month, and last day of the quarter always have the highest in overnight repos in comparison to anything prior to it. The trillions of dollars in overnight cash that are tucked away at the Federal Reserve are going to be a major headache for banks that will squeeze their balance sheet and impair their ability to lend. The Federal Reserve repo facility has attracted tons of participants and mainly money market funds, which have had over 39 straight days now, 39 straight days over $2 trillion. Their repo rate, as shown here on their operations desk, is 2.3% after the 75 basis point hike we had last week. It is always the interest rate plus 0.05%. Barclays is now estimating that the daily reverse repo will hit nearly $3 trillion by the end of the year. The reverse repo is absolutely necessary in order for banks to maintain liquidity, as increasing, basically the increasing requirements from the Federal Reserve on the bank's stress test has made it so that they have to have more collateral, and in the form of cash. So this cash collateral basically prevents these banks from having to close out their short positions on heavily shorted stocks and meme stocks.
Was this kind of overnight operation put into place today? But remember also, throughout the course of the past couple of weeks, we have seen a string of these overnight operations, and then we even saw a 2-week operation happen over the course of the last week or so. So the idea there was that between these multiple overnight one-day operations and one where you had longer terms that would carry you into October, that you could see some of those funding stresses alleviated. And we have seen that. And one of the trends that we will point to is that over the course of the last week and a half, guys, we have seen the use of these Fed credit lines for these repurchase agreements used less and less, undersubscribed, so to speak. So it may indicate that the bank-to-bank lending market is taking over where the Fed would have been. So that's probably a good sign for some out there, guys.
That statement didn't age too well, did it? Seeing as how we're now $2.156 trillion. The Federal Reserve is supposed to shrink their balance sheet by $95 billion a month beginning in September, accelerating their supposed quantitative tightening, which hasn't really done much since the beginning of June. The concern is that outflows from banks into money market funds could reduce the reserves at a faster pace that would further hinder lending activities to the financial markets and economy. The repo allocations that come from these government money market funds has increased to nearly 40% of their assets, which is a pretty large increase from the beginning of the year where it was under 30%. This could also lead to a further spike in the repo and effective Fed funds rate, similar to what happened here in September of 2019 when bank reserves dwindled due to the heavy withdrawals for tax payments and the settlement of treasury purchases at auctions that forced the Fed to provide additional reserves and step in and take over the repo lending market. This the move into money market and away from banks just further illustrates the requirements that these banks are facing in their increasing collateral requirements to maintain their current margin positions on heavily shorted stocks. For now, bank reserves are around just over $3 trillion, but has increased over $1 trillion from December of last year. That's a 23% decline. And in the Federal Reserve's previous QT, 1.3 trillion was withdrawn in 5 years. So in 2019, it took 5 years to reduce, to taper, basically to tighten by 1.3 trillion. And we've already removed 1 trillion off of equities markets in the last, since December alone. There's going to be huge factors such as loan demand and reallocations of funds and people withdrawing their funds, such as BlackRock being down $1.7 trillion this year alone, that people are going to continue to see as more and more capitulation occurs. The government money market fund assets have been fairly steady, but the shift to these monetary funds is a slow process. Bank reserves are set to fall quickly as cash shifts out of these bank deposits to these government-only reverse repo program that is, again, $2,156,000,000,000, 13 million fucking dollars. The U.S. Treasury will increase the issuance of Treasury bills for the fiscal year of 2023, beginning in October, supposedly to help ease the outflows of the other markets and inflows to the reverse repo. There's an estimate that bank reserves will fall another $1 trillion to 2.3 trillion this year, very similar to what we saw in the past with Lehman Brothers and Bear Stearns, for example. So the Fed's balance sheet increased with this QE during the pandemic, and their bank reserves that were deposited, once they reached a level at which banks were no longer willing to absorb the costs on their balance sheets, they started turning away deposits. That's when the Fed had to step in. In April of 2020, right around the whole COVID lockdowns and executive orders that occurred there to print more money, the Fed temporarily excluded treasuries and central bank deposits from their supplementary leverage ratio. This is their capital adequacy measure, basically. Bank deposits and cash and treasury bonds raised that were required by banks because of the increased requirements, for example, Phase 4 and Phase 5 of the new CAT system. And now Phase 6 implementation is coming soon as well. And Phase 6 implementation is going to further increase the initial margin capital requirements. So increasing the margin capital requirements, meaning they need more money on hand. So the RRP is going to continue to go up, and the Fed let that that supplementary leverage ratio exclusion expire, and now big banks will have to continue to hold even larger amounts of this capital to absorb against losses, which in my opinion and in many others are absolutely inevitable at this point because of the over leveraging by banks. For example, Goldman Sachs, 133 to 1. Goldman Sachs has only around $2.5 trillion in assets, but holds around $100 trillion in toxic derivatives notional value. Banks are still not interested to increase the deposits due to this relief, and they want to free up their balance sheet. They're sending a message to the Fed that they're going to need a fucking bailout. If the Fed tweaks the SLR, the supplementary leverage ratio, and gives banks the room that they need on these regulatory costs, that would be a further bailout that would push these financial institutions to accept more deposits and help stabilize reserves at the expense of increasing inflation even further. The Fed earlier this year said it would review the leverage ratio, but has yet to publish any proposal as such.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning, and it's not just Bear. Pretty much every single bank is plunging in early trade this morning. Lehman, which is very similar to Bear and its reliance on fixed income, is down nearly 30%. You have big names like Goldman Sachs down 8%, Citigroup down 8%. So it is pain across the board this morning, and as you know, it all emanates from the shock this weekend that J.P. Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160. It is the fifth biggest bank on Wall Street. It is significant in that it is establishing a price for some of these hard-to-value securities, and as you are well aware, that price is pretty much zero, and that's why you're seeing pain across the street. Now, this also...
Oops. That doesn't look so hot for Bear Stearns there. And you know what? This is very clearly, if you look on the stock markets, you can see that it appears that banks such as JP Morgan and all the big players are moving money overseas in an effort to, enrich themselves and get money out of their, how can I put it? In an effort to move money where they need it. Because in the United States, it's not really going to do them a whole lot of good right now. American depository receipts have been used in the past to launder money with great success. 18 days ago, we had a stock by the name of AMTD, hashtag AMTD is the stock ticker, debut, and they were at just a couple of bucks, I think around $7 or so. They are now a They have a $1.5 billion market cap, as their price today increased $866 a share to $1,608. Again, about just a few days ago, about 14 days ago, their stock was around $7 a share. Their depository receipts were trading at more than 230 times their IPO offering on Tuesday, with a surge continuing after the company discussed the stock activity. They said, quote, "To our knowledge, there are no material circumstances, events, nor other matters relating to its business and operations since the mid-July IPO," AMTD Digital said early Tuesday. The ADSs were trading at $1,800 each, up 143% compared to the $7.80 IPO. They said supposedly they're still undergoing a stabilization period. If you ask me, just in case you guys are wondering, HKD and AMTD here are partially owned by a person who has been embroiled in previous scandals. That's an increase of 32,229% as of their July IPO. This is billions and billions of dollars that have been leaked into a Chinese globalist crypto bank, and nobody seems to notice.
Well.
That's what I said, Cash. Fuck it, we're going to do it live. And I've only got another minute before I've got to go. But this is not normal. This is money laundering at its best, to go from $7, $12 a share. An 32,000% increase on this stock is absolutely, absolutely criminal. It is a way for banks here in the United States to send money overseas, and then potentially and allegedly, since I don't have any actual physical proof other than the speculation of a stock running up 32,000% that just IPO'd 2 weeks ago, so it's not heavily shorted, so there's no way it could be a short squeeze. Therefore, leads us to believe that if HKD makes around $25 million a year, and they have now surpassed a $340 billion market cap, billion with a B, making it one of the top 20 most valuable companies in the entire world. In the entire
that's very suspect.
Exactly. The SEC should be on these guys' ass. These guys should be in prison for this. This is not normal in the slightest bit. Some people I know jumped into this, but there's a reason that these stocks don't have any options, because they don't want people like you and I to be able to get leverage on stocks that are going up and down by tens of thousands of percent, especially ones that recently IPO'd in China, and Chinese companies, for example, trading on American depository receipts. That being said, I'm going to leave this video at that. But I will say this. When you see things like this happening, they are signs of absolute fucking desperation. The RRP could potentially hit $3 trillion before the end of the year, but I wouldn't be surprised to see that the United States and global equities market completely collapse before that occurs. And heavily shorted meme stocks, when collateral is dried up, you're going to see these heavily shorted stocks such as AMC and GameStop, BBIG, etc., MMAT, all the most heavily shorted stocks that have dividends and tokens and dividend splits and stock splits attached to them that have yet to increase in price. Well, that's actually going to probably be properly reflected at that time, because when margin calls happen, the banks don't give a fuck what the DTC has to say. They want to get their money back from the hedge funds and the family offices and the over-leveraged pricks and retail investors that have taking out way too many positions and over leverage themselves, as they're going to need more and more liquidity on hand to maintain their margin positions and reduce further losses. Just a few days ago, this is why on Friday, at the end of the month, the end of Friday, July, we saw an all-time high RRP amount at $2,300,200 million, an all-time high interest rate bailout at 2.30%. This was a typo. An all-time high number of market participants at 111 participants that were desperately cooking the books. Just absolute ridiculousness, time and time again. Americans should be outraged.
Peak forgery.
Absolutely. Absolutely.
And Citigroup down 8%. So it is pain across the board this morning. And as you know, it all emanates from the shock this weekend that JP Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160. It is the fifth biggest bank on Wall Street. It is significant in that it is establishing a price for some of these hard-to-value securities. And as you are well aware, that price is pretty much zero. And that's why you're seeing pain across the street. Now, this also...
How'd that fucking work out for him, huh? Good luck, everybody. Wish you peace and wealth. I'll catch you tomorrow. We're going to be so fucking rich. And before we go, I just wanted to note to everybody that we are going to be airing a video here with Dr. Diane Garrett, the Chief Executive Officer of Highcroft Mining. We will be interviewing and airing this on August 4th. August 4th, about 30 minutes before the AMC shareholder meeting. So it will air around 4 p.m. Eastern Time on August 4th. I'll see all of you retail investors there. Stay cool, you fucking degenerates. Peace and wealth. Motherfucker. Shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. Sorry, there goes the song. I decided it's gotta stop. So fucking Griffin, I want my fucking money.
You're an original,
Hey,
aren't
yelling,
you?
give me the fucking money. Get the goddamn money printer out.
Great.
Big shout out to Owning the Float and Bajos. Appreciate you guys.
Bounty
Thank you guys for being awesome supporters of the think tank. Thank you to Owning the Float, thank you to Bajos, Grandpa Barney, everybody. Appreciate you guys very much. So fucking rich. Get the goddamn